Hello, and welcome to HAVE.crypto's YouTube channel, where you can find and learn everything about crypto markets and trading. In today's lesson, we will talk about market cycles and how they are based on simple rules from the general psychology. So, take a comfortable seat and let's get started. Market cycles refer to trends or patterns in the market that emerge during different markets or business environments. During a market cycle, some asset classes may outperform others depending on the conditions in the market cycle. The time frame of a market cycle differs for individuals, depending on the market in question. It can range anywhere from a few minutes to many years. For example, a day trader may be looking at market cycles which last for 10 minutes, while a real estate investor may be looking at a cycle lasting up to 20 years. It is almost impossible to exactly pinpoint the beginning or end of a market cycle, or what stage of a market cycle we are currently in. However, all market cycles go through the same stages, rising in the beginning, peaking at the top, before dipping and bottoming out in the end. Market cycles are cyclical in nature, and the end of one cycle represents the start of a new cycle. Wyckoff Market Cycle Theory. Richard Wyckoff, a stock market leader in the late 1800s and early 1900s, studied, analyzed, and traded on the stock market. He viewed the market in terms of supply and demand, having observed the markets and their reaction to fundamental information and the seeming disconnection between market price and stock fundamentals. This leads to the Wyckoff Market Cycle Theory, which is based purely on market cycles and price actions. There are two rules to keep in mind for this theory. First, don't expect the market to behave exactly the same way twice. Second, market behavior is significant only when it's compared to what it did before. In addition to the two rules, there are three principles. According to the Wyckoff Market Cycle Theory, a market cycle typically has four distinct phases: accumulation, markup, distribution, and markdown. Accumulation. The accumulation process is the first phase of the market cycle and begins after the market has bottomed out in the previous cycle. As institutional demand increases, prices find it difficult to form new lows, and the downward trend begins to lose its momentum. The market becomes increasingly bullish, and this is the best time to buy into the market, as prices are still low and a trend reversal is about to take place. Markup. The markup is the second phase of the market cycle, when the market starts to consolidate. As prices begin to move higher, the market attracts a large number of buyers who want to join the new upward trend in its early stage. A bullish price trend emerges and pushes prices to new highs. Distribution. The distribution process is the third phase of the market cycle. During this phase, the market experiences a sell-off. However, prices remain stable for quite a long period of time, as there is an equal distribution of buyers and sellers. The bullish market sentiment during the markup stage starts to disappear, and there is an absence of new highs. Investors who have not entered the market stay on the sidelines as the market sentiment begins to turn bearish. Markdown. The markdown is the final phase of the market cycle. At this stage, investors start to sell their investments in order to lock in profits, and many others quickly follow. With prices falling in a downward trend, the market sentiments become increasingly bearish. Some investors who entered the market when prices were at their peak may hold on to their investments with hopes that the prices will rise. Unfortunately, prices continue to fall, and this provides a buying opportunity for investors who are able to identify the end of the downward trend. When this happens, the accumulation stage begins and a new market cycle is formed. Before moving to the next interesting part, psychology, make sure to like the video, subscribe to our channel, and click on the notification bell. It's free. The cycle of market emotions. Investors often make financial decisions, good or bad, based on their emotions. Research has shown that emotions play a significant role in investing. Investing based on emotions, greed, or fear is the main reason why so many people buy at market tops and sell at market bottoms. The cycle of market emotions shows the series of emotions that investors are likely to experience as their investments rise and fall. there are 4 phases of the cycle of market emotions: optimism, enthusiasm, thrill, and euphoria; anxiety, denial, fear, and depression; panic, capitulation, despondency, and depression; hope, relief, and optimism. Understanding this is important in order to protect you from reacting irrationally to the cycle of market emotions. In fact, this understanding may even allow you to capitalize on the cycle of market emotions by doing just the opposite of what most market participants are doing: buying when they are panically selling and selling when they are enthusiastically buying. As Warren Buffett puts it, be fearful when other investors are greedy, and be greedy when others are fearful. Thank you for watching our video. Next time, we will continue digging into trading basics, and we will discuss one very important and interesting topic: candlestick patterns and formations. Subscribe and don't miss this opportunity.